Hey, what's up, outliers? Happy Friday. The video today is pretty open-ended, actually, because I'm in the process of building new material for a deeper look into the options Greeks. That's actually going to be the next series. So for those that don't know, the Friday streams were originally designed to be, it was actually like very set series. And then I just kind of kept continuing doing the beginner friendly Friday streams because I think it's useful and a nice place for people to feel comfortable asking questions, talking about stuff that they might otherwise feel uncomfortable. The lens that I apply to everything I see in the chat on the Friday stream is with as much grace as I possibly can. Just that this is somebody that is asking a question about something they don't know. And I do not think that that's a bad thing. I think that there's enough. I don't know why people feel like some sort of, it's super annoying when people who know something have this like superiority complex over somebody who doesn't know something. I typically see that come out through like sarcasm, and it's the dumbest thing on earth because it's like literally all of us start from the point of not fucking knowing. And then the difference between not knowing and knowing is just a learning process. It literally doesn't make anybody like better than somebody else, but sometimes people can really make it seem that way. I see it online a lot when people are trying to ask basic questions and they're getting the treatment. So really this is designed to be a space for people to get live answers to stuff that they're wondering about. So the idea for today though is two things. I do want to talk about 4 different questions. I don't know if we're going to get to all 4, but I got 4 questions this past week from a mix of people. One of them was from Reddit, 2 of them are from pro members, one of them was from an email. And I didn't answer these in depth. I do my absolute best to respond to everything that I get, at least in some way, because people are humans, and I think that they deserve, at least as long as it's sustainable for me, right? Like as long as it's not like overwhelming, but your boy's not going to be a celebrity, so we're not so worried about that. So I do my best at least to respond to everybody. The caveat though is a lot of the things that people will ask, sometimes they have a lot of nuance. And the reason why I started a YouTube channel is not because I think I should be on YouTube. It was literally to answer questions that I was getting. And it was easier for me than trying to write everything out because that takes a while. So that's the idea. We'll talk through a couple of those questions that I got for this week. I'm going to paraphrase 2 of them because I think this specific question is fine, but I think I can zoom it out to make it more relevant, more broadly. And then I want to talk a little bit about the upcoming series. Actually, I guess we could do that in reverse order. We'll start with the series overview, get your thoughts, and then we'll go from there. The reason why I want to get your thoughts is because for the people that typically show up to the Friday streams, you are the folks that ultimately this is for. So I would rather build something that's relevant to you, the people that are actually on the stream, so that it's just a better use of your time. So it'll still be useful to a larger audience that watches the streams and whatnot. So let's first start with the next series that I have in mind. My vision here is essentially a Greek deep dive. And my plan is for each episode, there will probably be 5 or 6 episodes. I was kind of, I was mapping it out. The first episode will be just an overview, right? Because this is still a beginner series. And I want to get everybody on the same page with the Greeks. So this will cover a very high level look. This will build off of the existing videos that I have, and I will use those as the base starting point for us. So that'll be the first episode, EP1. Then the next episode is going to go through the individual Greeks in order. And when I say order, it's kind of in what I would consider to be a logical order. Rho, unfortunately, being the redheaded stepchild, does not get its own episode because I really don't think it needs one. But then there will be like an advanced. The advanced episode is us diving into higher order Greeks and the interdependencies between Greeks. So understanding, for example, the qualities of charm and how there's this idea of delta decay based on time, and how Vega is giving us useful feedback on sensitivity to implied sensitivity or implied volatility sensitivity and changes to that with respect to premium. But then Vega itself is sensitive to passage of time, to spot price changes, stuff like that. So the advanced episode will be another click in. I still would not in any way genuinely consider it quote unquote advanced. And broadly though, I'm hopeful that it will start to bridge a gap, because this is actually one of the questions that we're going to talk about today. So before I pivot to the question that's related to this, I would love to get your thoughts on at least this layout. And then the way that I'm going to build this is like, for example, delta, we're going to go through what it is, then we're going to talk about the math. The purpose of the math is not to spend a bunch of time on it, but just so that you understand and can visualize the inputs. The reason why the inputs matter is because it's going to help your brain understand the relationships between the different things we're going to talk about. So when you realize that for delta has a series of inputs, that when you get to something else and you realize like, oh shit, that has some of the same inputs. That's interesting. There's probably a relationship between those. That's the idea. So that will be a quick section. And then the spot that I intend to spend the most time on is use, and then tips and tricks. Now, tips and tricks in my brain, I already have this built out for delta, is it's going to talk a lot about the different kinds of ways delta can be used. Now, tips and tricks will differ based on the Greek that we're looking at. So for example, theta, there's not like a ton of tips and tricks. There's some, but not a ton. But with respect to something like delta, there is a ton. So there's things like using it as a probability and why that works partially. I have a video that talks about that in depth. And again, it's looking at the formulas between calculating the implied move of something and the expected probabilities versus delta. So all of that, there's existing material. But then there's stuff like understanding how you can use delta to understand dealer positioning and likely dealer at intraday or short-term trading activity based on how their delta exposure might change with respect to the passage of time via, again, something like charm. So the tips and tricks section will get a little bit deeper. So this will pretty much be what it is, though, for all of them. So each episode will have this general layout that dives into this kind of detail for each Greek by itself, so that we will spend some additional time on theirs. So would love your thoughts on that. If you want to share them here, cool. Throw a comment in. That's awesome. Immediate feedback is always good. And if it's something that you're noodling on or you want to think through anything that you might want to add, tell me. Because again, these series are really designed to be, they're literally for you. So I already have videos that talk about all the Greeks. Everybody can check those out whenever they want. I understand that that doesn't always scratch the itch and really complete the topic, which is the purpose of the stream as a supplement that is accessible to everybody. Ethan says Greeks are one of those things that are fairly easy to learn, but insanely difficult to master. Yeah, I completely agree with you. And it's funny because the Greeks by themselves, they're like pretty straightforward, right? Like delta, pretty straightforward. But once you start double clicking into them, there is a lot of nuance. You'll find that really with options trading in general. Options themselves are really not that complicated in a vacuum, right? Like if we zoom all the way out and we think about an options contract, it is an agreement between two people that pertain to a specific asset about some price at some point in the future. Okay? Then we can think about how the value of that contract can change due to changes in spot price, changes in time, changes in vol, right? Like all those kinds of things are conceptually simple. But the game is always putting it all together into something that actually leads to trade decisions. I think that's a big difference with the way that I approach trying to expose people and help people learn about options. Is I really tried to keep it pragmatically focused, because I didn't start learning options because I was just so fascinated with options. It's just not the case. I started trading options to make fucking money. That's it. Like that is why options were the route I went. It's not because I just thought that they were like super cool and I wanted to do a research thesis on it. It's just not the case. So I understand that a lot of people that are looking at this probably are starting with that kind of at least launch point. Now, the cool part is I definitely do find them fascinating at this point, but it's because I've spent so much time learning and analyzing them that you really do begin to build a deep appreciation for stuff like this, because it's like seeing something really pretty in nature that will always cause me to like take a second, look at it, absorb it, acknowledge it, enjoy it. Options really are kind of the same thing, because they really are elegant instruments. They do a lot and they're efficient at what they do. I have a video that's coming out not that long ago, or well, that's actually a complete lie. It's not going to come out forever because I have an entire pipeline built, but I made the video not that long ago about a series of recent trades that I made based on options activity. And the point is, options contain tons of information. So this will talk a lot about that stuff. Ethan says, I've recently started using time primarily to increase my risk rather than strike price, something I didn't comprehend when I started for short options. Started using time primarily to increase risk. I don't actually totally follow. What do you mean? Because then you throw delta in parentheses. Jamie says, watched your interview with Humble Trader. Not sure when it was. Great job. Oh, awesome. Thank you so much. I'm glad that you enjoyed it. I think I did that. It's got to be like a year or two ago, I imagine. Because I actually went to Vancouver to go hang out with her in person. She was super cool. Ethan says, for instance, rolling 7 DTE to 14 DTE to increase deltas. I see deltas as risk. Yeah, I think delta is okay to consider risk, but in terms of the relationship to time, like going from 7 to 14 DTE doesn't really increase your delta. Your delta will be what it will be. Now, the way your delta changes might be different. So, for example, if we take a look at Tesla and we take a look at 7-day option and I look at, so Ethan says same strike price. Yeah, see, and that's the thing is I wouldn't do that actually, because the delta normalizes based on time. So, for example, in selling options, I would absolutely use delta. I wouldn't bother with what the strike price is. What the strike price is really doesn't matter. It could be anything. This is just a number. But if we go from 7, let's say we're selling a 29 delta put, which is 315. If we go further out in time to that 315, we move, as you rightly know, up to a 35 delta. But the comparison that I would do instead if I was selling options is I would just use the delta to normalize based on the time. Which that actually leads to a fun discussion question while we're here. This isn't exactly one of the questions I was going to review, but it is proximal, which is trying to understand the relationship between the Greeks across time. So why is that? Who can explain to me in some sort of way? If you're in the Discord, by the way, and you want to go into the voice chat and explain it to me in a voice chat, I can stream it on the thing for everybody to listen in. If you feel like doing that, let me know and we can do that. If not, just throw it in the chat and talk to me about why we think this is. Why is it that the 320 fits? So we'll do this one. Why is it that the 320 here has a 35 delta? And then if I go to the 320 here, it is a 38/39 delta. Why is that? Lauren says, I've been buying further out in time than I need. I understand what you're saying. That's good. I wouldn't personally say what you need, right? The reason for what you need is a little bit of a common misnomer in terms of like when you expect the move to be. Jamie says time value or theta. Good guess. That's not quite. Think about what delta tells us. The rate of change of an options premium per 1 point move in the underlying. So if we have the same strike and we go further out in time, you have part of the equation, which is the time element. There's a clear effect by time. Ethan says, I guess I need more context. When I sell a put, I want to be able to follow the market up, but don't necessarily want to buy shares at higher prices if there's an immediate reversal. Yeah, Ethan. So in that case, that's totally cool. I wouldn't bother with what strike price you use. I would use delta for that, especially in that context. Especially the only scenario I think where worrying about the strike price in this context that matters is if you do want to take assignment and you want it to be at a certain price. But that part aside, since that's not the case here, then I wouldn't even bother with strike price. The strike doesn't matter. The delta is ultimately what matters. Greg says extrinsic value for the difference. It's not extrinsic value. It's definitely part of it for sure, but there's a little bit more to it. Why is that? So Greg says probability of falling in the money. Probability is a part of it. So, and this is the fun part of the conversation, at least from a nerd lens, is this also grants a peek as to why there is a relationship between an option's probability of being in the money versus delta. So for those that don't know, I have a video that talks about delta as a probability. It's a little old, but nonetheless, it talks about this. I'm going to pull it up super fast. Mostly, honestly, I'm just kind of curious what it even looks like, what the video looks like. So this is me laying a sick hook that everybody is going to be absolutely stuck stuck in. Delta as the probability for an option being in the money at expiration.
What a good hook.
Anything, sir, you can find it through the up to so we can see so duplicative, whatever. Expiry anybody.
I think there's a spot in here where I show the formulas.
Sure,
oh, there it is.
Universal, some of this in. So I'll walk you through it. Don't worry. You don't have to know this information in Black-Scholes model. Here's the first one so that you can see.
Okay, so for those that are hanging in there so far, by the way, what a wild spot to freeze. Damn, that's hilarious. But this is talking about how we arrive at the theoretical price for an option, and then it changes whether it's a call or a put. But what I'm doing is I'm highlighting a key component, which is ND1, which is a cumulative distribution component to this that then gets into a couple really important inputs. So if we take a look at this, ND1 is your delta. So clicking in further, I think there is a side-by-side somewhere in here. Oh yeah, right there. So this here is the actual formula for a probability of being in the money. So what do you notice? Well, there's a lot of overlap between what delta is in terms of a calculation versus what the actual probability calculation itself is. So the reason why you see a change is partially due to extrinsic value increasing. That's absolutely correct. And the more important component is as that time changes, which is, again, the largest contributor here, but it's what that means. Why does that matter as time changes? It matters because we can expect different movement profiles for an option that has longer to go. We also know that options in different expirations behave differently. So, for example, I think I have an updated plot. One sec, let me see. Let me see if I'm lying to you or not. Let's see. I didn't drop it in yet. One sec. I literally have the updated plot, I think, available. So I'll show it to you. Yeah. So just pretend that that's there. This shows you the behavior, the behavior of option delta with respect to strike and time. So strike price on the bottom, delta, y-axis, time is the various plots that you see. So the cool part that you'll notice as you just eyeball through this is longer dated options have a much less steep and consistent slope as compared to really near-term options. And it's because really near-term options are making a very big decision, whether they're going to be in the money or out of the money, meaning have intrinsic value or not. So all delta is going to approximate to 1 or 0. So you can see how this gets steeper as we get closer to expiration because it does become a binary choice. You're either in the money or out of the money. There is no middle ground. So it's for those reasons that you see delta change with respect to time. It's the underlying force. So time itself is ultimately what drives that change. But it's the implications of more time that ultimately lead to the behavior that you see. Kind of a fun, completely random aside. But yeah, I like that. Ethan says, hold on, I realize. I think I'm all caught up.
Lauren says, okay, that's what I meant. Further out delta isn't as reliable for delta being a probability. Yeah, that's exactly correct. Good job. So if we take a look at the comparative calculations between delta and probability of being in the money, let's take a look at this one. So this is the 315, 7 days out, 29 delta. If we take a look at the probability of being in the money, it's 32.55%. So this is 7 DTE. This is delta. Delta probability. And then probability of being in the money. I'll zoom in so that it's a little easier for you to see. Okay. So delta was 0.29. 0.29. So that means our delta probability is 29%. The actual probability is 32.55. So there's a 3.5 point difference between these. Okay. So now let's go further out in time. We'll do it maybe twice. Let's go 28 days. I'm going to move this off to the side just so that, as always, I can go a little faster. And then I'll show you the composite. So this is 28 days. Delta, we're going to try to find the closest to 29, which will be this one here. So this will be 0.31 delta. The actual probability here of being in the money is 36.2%. Let's do one more. Let's go to, I want to use a major expiration. We'll do 15GN27. So this will be 546. And there's actually one other version of this that I want to do because I think it'll be really informative for you guys. So this is 0.29 delta. Actual probability of being in the money is 54.31. So this is what you see so far for Tesla. Okay. And I made it a color to literally burn out your fucking eyes. Well, I guess the better way to do this, TBH, would be this. I'm gonna make a plot between them in case you're a visual learner like I am. And then this next one, what ticker do you guys want to use? Pick something that you think is boring. Something that you don't think moves a lot. And for the context here, Tesla vol is 61.42. Vol is 61.42. Row, Ford. Yeah, Ford is boring AF. Great pick. So this one will be Ford. Ford vol is 44.23. And let's see what deltas we can get that are closest to 29. So 7 days, this is the downside. We'll have to use something else. Ford is just too cheap, so it doesn't have enough strikes. Something that's more expensive but slow would be better. So well, we don't want to use an index ETF. That would be honestly the best. GE is good. This will give us good deltas. So GE is 29.79% vol. So, and because it's expensive, we'll be able to find stuff that's real close in terms of deltas. Yeah, this is way better. So our first will be this 35 delta. I'm just going to use the primary strike, 0.35. The actual probability here $36.3. Okay. Now let's go to 28 days. It's a good zombie movie, by the way, 28 days later. We'll do the 250s, which is 24 delta. The calculated probability here is 25.98. And then last one, 546, 29 delta, the 240s. So this is a 30 delta, really. Oops. Probability is 44.06. Cool. What do you notice? Talk to me about what you can detect from the exercise we just did. What's the difference between these? Start here. Teach me. Probability. Good job, Lauren. It's good to see that you are able to read. That's always good to see. Talk to me about the relationship. What's the relationship between delta and probability of being in the money? Let's start with that in general first. So we don't have to make it between Tesla and GE just yet. What's the first thing you notice? What do you notice about the variance as we go further out in time in both instances? Between delta is the probability and the actual input calculated probability of being in the money. Does it increase or decrease as we go further out in time across the board for both tickers here? There you go. Ethan's on it. So Ethan says delta as a probability gets worse the longer the DTE. That's exactly correct. Good. Now, what's the next thing you notice about the probability difference between Tesla and GE? So using 7 DTE, we see Tesla, the difference between delta and probability is 3.5 points, 3.6 points. And the difference in GE is 1.3 points. What do you notice there? Which one of these has a higher variance and why? The cool part is, well, I don't know exactly who's on the stream, but I know that some of you know this. I just don't know who's on here that might know. Okay, good, good, Both Ethan and Lauren. Good job, Lauren. Especially good job, Lauren, because I know you're newer to this. That's fucking awesome. It's exactly correct. You're seeing the impact of volatility across two different vectors. You're seeing the impact of volatility between individual names, and then you're seeing the impact of volatility as you go further out in time. What happens to Vega if I were to plot the Vega for the 7DTE versus the 546? Which one's lower, which one's higher? Let's just say for the 29 delta option. Which one of these is going to have higher Vega? Palash is correct. It will increase as you go down this. So Vega here will be low, and Vega here will be high relative. So what you're getting here is literally a crystal clear depiction of how volatility impacts both of these across two different time frames. So when we're using delta, delta is pretty close if you're in short-term options in something that's not very volatile, that does not have a ton of IV. Notice this is only 1.3% off. This is 3.5. That actually starts to get pretty pronounced pretty fast. And then notice how you go further out, it's pretty bad for both. So delta as a probability works, but it's nuanced. And you kind of have to pay attention to what actually makes sense for the strategy that you're running, because one of the issues is if you're using delta as a probability and you're putting on a strategy that requires a certain hit rate, you literally, in this case, you literally can be 25% off. It's a really, really, really big variance that is no bono. So this is the concept of delta, the relationship between delta probability of being in the money, the variance between those, and then the relationship both of those and the difference have with respect to time and vol. Solid lesson, hopefully. Afghan Battle Rat, what up, boy? Says, is it time for calls on GameStop? I really think that just depends on, do you think GameStop's going up? Because so far, it's just going sideways. Ethan says, never realized it was that bad. Makes long-dated short options seem even worse. No. Don't take that away, Ethan. It just means that if you did a longer dated option, you don't use delta as the probability. You use the actual probability calculation in order to get the probability that you want. So, for example, going back to Tesla, if I want a short put that has a 30% chance of being in the money, I can still do that. I just need to use this. I need to be at a 11 delta. That gives me that 30% chance of being in the money at expiration. That's all. Now, the reason not to sell longer dated option is deeper than this relationship. So, Ethan, I wouldn't take away selling long dated options as bad because of the relationship between what we just went through. I think it's more important. Yeah, it's warm in here. Shirts off. I think it's more important to look at it in terms of the relationship of the probability that you want, right? Because you can still get the exact probability that you want. Now, that said, the primary reason why you don't want to use typically long dated options for selling premium. Exactly. So Ethan, you're correct, is that theta decay is slow. Now, again, even that can confuse people. It can confuse people sometimes. So for example, let's take a look at Trying to find a good example, because these still have a lot of extrinsic value. We would need something cheaper. Let's try Ford. Let's see if this is a good example. Yeah, this is a good example. So if we take a look at different expiration cycles for something like Ford, I'm just picking something for the example. What you'll notice is that your theta for near-term options can actually slow down relative to other options. So there's a very, very specific reason why that happens. So for example, if I take a look at this 0.13 delta put, this does not have 0.002 theta, maybe somewhere around there. It's probably less than that. Like this would be out another decimal place. This is being rounded, I'm sure. If we look at that compared to the same 0.013 option out here, if we had enough, you might notice that the difference between them can actually tighten up. The reason for that is because options that are near to expiration will be at the steeper part of the theta decay curve. But if they're far enough out of the money, there's not enough extrinsic value to literally decay out. So then there isn't anything left to come out of those options. As a percentage of the remaining premium, the number will always be huge. But as a raw amount, it will be very, very small. So just I think it's an important caveat to keep in mind, because sometimes going a little further out in time, you might not get the best rate of theta decay as a percentage of the remaining premium, but you might get more raw theta decay as a gross number. Hopefully that makes sense. If it doesn't, let me know. Shahzad says, might have to catch up offline, but would love to do a deep dive into leaps, when to use, why. How does underlying price movements in the short term affect leaps option pricing? That's a great question. We could talk about that real fast. Easy. Let's talk about long dated options. So let's use, I don't want to use Ford. That's boring. Let's use Tesla because we're here. And let's talk about leaps. I have actually a video outline. Wait, hold on. Do I have this one shot? Yeah, so Shahzad, I have a video coming out on 31 August. So it's going to be a minute. But I have a video coming out on 31 August that talks about leaps option trading strategies. To give you a prelude into what you will see there is the way to think about leaps is it's just an option, right? So the question really is, when does what expiration make the most sense for your idea? The short answer to that is, typically speaking, if you're using leaps, it's something that you want to hold for a longer duration and you want to minimize your theta decay. As far as near-term price impacts, it's actually really, really easy to sort that out. So if we take a look at 17 July, 364-day options, let's say that we buy this at the money call, the 330. If Tesla goes up $1, the premium on these are going to change by 64 cents, right? Delta tells us how these options are going to change. So Delta, and this is why I say in this context, Delta is the same across expiration. It doesn't matter if you have a Delta that's near term in expiration or further out in terms of expiration. The impact is the same. Delta is Delta. So you use Delta to measure that.
Now, the key changes that come into this are how gamma is impacted and impacts delta by time, and then subsequently theta, because your overall theta, your rate of theta decay will go down, but the total theta that you can lose obviously will go up. And you're going to have way less gamma if you're further out in time. So it's really just whatever you're trying to trade, that balance, whatever continuum in terms of days to expiration, results in you deciding going further out in time is the right position. But the easiest way to start at that is how long do you want to be in the position, for sure. Shahzad says, I had an idea TLT would go up with interest rates going down by the end of the year, but 90 call option expiring 2026. I think I bought this a couple months ago. Is that the right thought process? Not really. It's not bad, but you're missing a really, really, really important nuance of anything that has directional risk. So I'll draw it out and then we'll take a look at an actual example. So let's say that this is a P&L graph of your option. So this is the 0 line. And let's say that you buy your option, and I'm doing it as a time series. This is not a standard risk reward graph. Like the bottom part down here is not spot price. This is time in trade, good old tit. So if you start here, you're going to be about 0, right? And then let's first plot the price movement of TLT. So let's say that we are, Shahzad said, how long have you been in this? Couple months. So let's say that we're 60 days in. So let's say that this is 60 days. And if we postulate the price behavior of TLT over the last 60 days, I don't actually know exactly what it looks like. I think it's down. Let's see real fast. Yeah, it's down. So it looks something like this. Oops. Kind of flat, drops, rallies, drops, rallies, drops. Something like this. So when you bought your call option back here, what ends up happening is as TLT goes down, the value of your call goes down. The issue is your delta is doing a natural job of providing breaks to the downside move, but that hurts you when it starts to go back up. Does that make sense? And if not, I will explain it to you. Okay. So the issue, Shahzad, with that is even though you might have that thesis for the long run, if the front price movement is unfavorable enough, even if you eventually get some version of the move you expect you will see, you still might not make money because the front part of the timing was so far off. So the way that this would resolve itself is that if the future magnitude was enough to overwhelm this, but this is, again, part of how options behave, because you start with your 50 delta, so you lose $50 per 1 point move. Then let's say the option, or let's say the underlying drops, your option drops now to a 45 delta. So now rather than losing $50, you lose $45 per point. And then let's say you go far enough, the move goes on long enough that you're at a 20.
delta. So this now means that you lose $20 per point. So now, as this thing starts its recovery, it's not like stock where it's linear, dollar for dollar. Because as it starts to go up, let's say now it goes up 5 points, something like that. Well, your delta might only go up to, let's say, 25 delta. So that means that you now get $25 positive per point move, but the variance between these two is only 5 delta. So even though this might be a 5-point move, you only gained a small amount of delta. Whereas the underlying equivalent would have moved up by 5 points. So this is why I always find it funny when people talk about the volatility decay of leveraged ETFs that trade options, because then they sometimes literally forget that options have a similar component. Now, it's not exactly the same, but the principles are the same, where it will have the good part about long options in this context is that it will slow you down on the way down. So spot price does not benefit in that way. So if spot drops 10 points, if you have shares, you lose the $10 per share. If you have an option over this gradient of 10 points, you might lose on average, let's say 0.475, something like that. So you'll lose less on the way down, which gives you a faster recovery point. So then why? What's the problem here? If we go down slower, then it means we don't need as much of a big move on the upside. Well, the problem is, as this 60 days have passed, you are losing money every single day. So that theta decay is pushing you further. This might be the delta contribution to your P&L. But then you're going to have the negative drag of your theta on top of this, whatever that is. So then that is automatically going to push your P&L lower still structurally from the theta element. This is actually why a lot of times when I'm trading longer term ideas in this, like for example, what I'm doing right now in SoFi, it's a big reason why I sell calls against the long options that I'm trading. I'm not doing that because I think that the short call is my income or that short call really offsets my downside move. It's literally just to help to subsidize the holding cost of the option. So let's take a look at what I mean by that. If we look at, let's say, what expiration am I in? I'm looking at my actual trade. I am in 18 Sep 26, and I'm in the 22s. 18 Sep 26, 22s, these. Okay. So if we look at these options, I think I can crunch this down so that we could look at both at once. If I look at these options, these are 427 DTE, and my theta is negative 0.007. So that's what I lose per day. So what I can do is estimate what my holding cost is just from a theta perspective. So let's say that I'm going to be 30 days in this trade. That's going to be my input for just a general expectation of duration. Can be, I would make this so that it can be whatever. You can change it. And this is our DTE or DET if you have dyslexia. And here is our theta. So we can calculate our theta carry by taking, let's add one more input, which would be size, so that we can make it relevant. So let's say that there's a 50 lot. So we can figure out what our holding cost is. It's literally just our theta times how long we're in the trade times our size times the multiplier. So 1,050 bucks. That's what it costs us to carry this trade for 30 days. So then what I can do is I can say, okay, how do I offset that cost? I can then figure out two different ways to go about this. I can look at some sort of short option. I can say, okay, there's the 25s for 66 cents. So then we'll have a strike, which would be the 25s. We'll have a premium, which is 0.66. This will also have a theta or theta. You want to be a little hood with it. Get yourself some theta decay. Our theta on these is negative 0.21. So you tell me, what's the next logical step here? What should I do next? Who knows? Or at least who has a guess? Fire those synapses. Take a shot. Take a fucking risk. Kirk says, could you be synthetically long and sell the put option at the same strike as the leap to collect the carry costs of the upside call? It changes the risk profile but offsets theta. Yeah, so you can do that. The main thing is it just changes the risk profile. But that's a completely different style trade, the synthetic long. But there's nothing wrong with that. Reese says sell short calls, offset with shorter out of the money calls. Okay, so how do we do that? We can literally figure out how many contracts we would need to do this. So we can start by calculating just a general offset. So the numbers work out beautifully. That's hilarious. One of these offsets 3 of these in terms of theta. So then I can figure out how many I ultimately need by taking this by this. I need 16.7, rounds up to 17. If I run 17, these always have to round up. If I round this to 17, my theta carry on a daily basis I'm making these the same for you. I can do the math and I can see what my daily holding cost is. And then what I can do is figure out how many I need from here in order to offset that theta. And that's really the broad point of the ratio call diagonal. It's to subsidize the cost of the leverage. Reese says, practically speaking, do you always try to maintain positive theta? Definitely. Yeah. In these kind of trades, not necessarily. I don't mind having time risk in stuff like this, but in terms of the overall portfolio, definitely. I absolutely prefer to be positive theta. I think having a set theta goal is a little bit of a mistake. And it's just because that, I think, starts to overvalue the potential profit side of that equation. Kirk says selling shorter dated options also changes the profit, capping it if it goes parabolic. If SoFi doubles, that dampens the profit. It doesn't cap it, but it does most certainly impact it, no doubt. There's no free lunch. So this is the trade-off that a trader needs to determine for themselves. And it doesn't need to be offsetting the entire cost, right? So you can model the trade and you can say, based on what I think SoFi is going to do, whatever that is, do I think that I'm okay with the P&L if we get a 25% move, if I have 17 shorts against them? Now, this doesn't take into account your ability to roll and adjust the shorts and all that kind of stuff, but it definitely is a component to the equation without a doubt. So in my approach, I very rarely try to wholly offset the full carry cost because I don't actually necessarily care quite that much, but you can see in terms of total deltas. This has a max of 5,000. This has a max of 1,700. Our total uncapped profit potential is 3,300. So then the trader simply needs to ask themselves, is this what I want? Do I want to offset X amount of my daily carry? Or if this is too much and I don't want to offset the full daily carry, I can downsize it a little bit. And then I can figure out what I'm comfortable with if I get the move. And a big part actually of making a logical decision there is based on your strategy and using your trade log to get those data points to make an informed choice. QQ says, I'm up about 60% on 10 leaps on Bull. Instead of closing the leaps, I sold 10 covered calls against them at 17. No, I don't think that's a good management to take profits while not closing them. Yeah, I don't think that's a good idea. I think when you do that kind of thing, you're muddying the waters a lot on what the position is. And there is a chance that
it doesn't achieve ultimately what you want. So what I would do in that kind of instance is, if I have whatever it is. So if we take a look at bull, and it's starting to run a little bit, and I want to take some profit, I would literally just close some of the trade. QQ says, I bought puts and sold the covered call right before close at highs. Yeah, well, and I mean, in that case, you're not really accomplishing anything, right? Because the puts are going to be really expensive relative to the calls. So that really isn't gonna, it's not gonna do anything for you. The limit of the downside would, again, just be better achieved by taking profit out. Literally just close some of the trade. If the goal is to take profit in something as it's moved, that's always the simplest and most direct way to do it. Just literally take some of the trade down. And if the idea is that it's a long-term hold, then what it's doing right now doesn't matter. This is a common thing traders do when they want the cake and they want to eat it too, right? They want to be able to take profit, but they want to maintain the long-term holding. Not a thing. It's going to come with a series of compromises that ultimately just moves you off of that generally desired target. So yeah, I think that that approach just doesn't make a lot of sense in my opinion. But it is something that people definitely do. I absolutely see that. And it's just by folks that, again, are trying to be tactical, which is fine. But I think that's an instance of overcomplicating the position more so than it needs to be. I would just take some of the trade off, set stops if you're so inclined, and then let it run. But yeah, selling puts or selling calls to buy puts, making the collar, that applies to stuff like stock, because a lot of times when you're holding stock, you get a yield, right? People will do that on dividend stocks where they want the dividend, but they don't want the directional risk. That means either direction, up or down. They just want the dividend. So to do that, they'll do low cost or no cost collars. And in that context, it makes perfect sense. They just want the yield. They don't want the directional risk. In this case, making a collar out of options really doesn't accomplish anything, because you don't get the yield either. So it's just kind of tying up money. So the way I would summarize all that is, I would just, for you, QQ, is I would just clearly define what you're trying to do, right? If you're trying to use this as some sort of like long-term thing, that's cool. Then let it be long-term. What it does in the near term shouldn't matter to you if it's a long-term thing, as long as it doesn't, cause you to change or invalidate your thesis, then it absolutely would matter. That's the first thing. The second thing is, there's nothing wrong with, depending on your strategy, having a method to take profits. And based on the way that you approach taking profits, can be done in a bunch of different ways. But scaling is typically the simplest. QQ says, look at the minute chart. I mostly did it because I believe it was being overextended, passing 16.5. What I'm trying to do is keep the leaps long term and sell 21 DTE, but I collected a huge gain. That's the thing, is like, you haven't collected a huge gain because the long options are still open. That risk is still open. So by selling 21 DTE, that doesn't realize the long calls in any capacity. It just gives you near-term income, which is fine. There's nothing inherently wrong with that. But it doesn't do anything to realize the profits on the long options that you have. Then when you buy the puts with those long calls, what you're doing is, on a longer term idea, you're now capping
some of the profit potential to buy downside protection. Whereas that can be more economically done by literally just closing some or all of the trade and then re-entering when you think it's the correct time. That's the cool part about trading. And it's the cool part about being a smaller retail trader is you can efficiently move in and out of stuff like that. QQ says, how about putting the near-term income together with the chance of the out of the money? Hold on. Putting near-term income together with the chance of the out of the money puts going in the money being profitable. So in that scenario, my leaps go down, but I profited from puts and covered call. Again, then it begs, why would you keep the leaps open? Like if you think it's going to go down and you're worried about playing the near-term price action, then, right? It's like a contradictory thesis. If you're playing the leaps for a long-term idea, then it should be a long-term idea. Now, that does not mean that you can't have the same underlying and trade two different time frames. But the way that you're framing it to me tells me you're not doing that. And you're trying to have your cake and eat it too, which doesn't exist here. So here's what I mean. If I have a long-term thesis in bull, and I think long-term it's going to go up, I can buy leaps. Call leaps. I also don't know why I insisted on writing that backwards. I'm pretty sure that's dyslexia. And then in that's a long-term idea in this hypothetical. So let's say that I'm planning for this to be a 2-year trade or whatever. I'm planning on holding this for a while. Okay. So that part's around down range. This is going to be based on fundamentals. It's really the main thing that matters for price ideas that far out in time. Then I can still trade bull in the near term. So if I think based on this rally, it's overextended, so I want to create a synthetic short. And to do that, I'm going to sell to open calls and then buy to open puts. I can do that and trade this near-term price action. However, there should be no crossover between these. This should not be done for this. And this should not be impacting this. It just doesn't make sense. So what I'm highlighting here is you can trade the same thing in two different time frames, but then in the way I would think about it is they're two completely different positions. I'm happening to trade the same thing, but they're two disparate positions and I wouldn't create overlap between the positions. If I think it's going to go down short in the near term, but that doesn't impact my long-term idea of this thing going up, cool. So then I trade the synthetic short or whatever version of the short strategy in the front, but that does not carry over into this. I'm not applying it to the P&L of the leaps. I don't care what the P&L of the leaps are, because in this case, I'm doing something for a longer term idea. So yeah, it's a really good question, but that's how I would think about it. Because as soon as we start trying to do too much with these leaps with near-term stuff, we're just confounding literally everything. And we're adding a ton of complexity that overwhelmingly likely is not going to yield the results that you want. And it doesn't ultimately achieve any sort of realized P&L protection, so to speak, of the leaps. The leaps are still open. Defense says, can you take a look at UNH options? Are UNH leaps too expensive? Yeah, let's take a quick look. Leaps. I assume you mean calls. Is that correct? Let's see. UNH. Ugh. Don't know why you would want to go calls right now. This partially takes what I was talking about before. with whatever the other ticker was that we were looking at. I think it was the TLT trade. Just because it's a long-term thesis doesn't mean that the short-term timing doesn't matter at all. It still does. And it can make a pretty significant impact on the total profitability of the position. So just from a logical standpoint, like this thing is going down. And even after this really long consolidation, it's starting to break down to the downside. So I would definitely keep that in the back of my mind as I'm looking at this, because it doesn't really look healthy, is at least as far as I'm concerned. So that part aside, just calling that a given, we can figure out how expensive the leaps are by looking at the vol curve. So we will do that in just a second. Your boy has got to get the dinner order going. And I don't really know what we're fucking with. What do you guys think? What's for dinner? What's everybody else having for dinner? Give me fucking ideas. Chip Chop. Yeah, Chip Chop fucked me up. I actually, to be honest, Reese, funny enough, I totally forgot that it fucked me up until you just mentioned it. And then as soon as that happened, it immediately came running back to me that it did fuck me up. Because I now distinctly remember that it did me super dirty. That's actually super, super hilarious. I totally forgot about that. Totally forgot about that. Damn, that's funny. That's so funny. Kirk says UNH has a news catalyst built in and could spike or tank at any time with the fraud news. So I would consider Leap a lotto at this point. Yeah, I think that's a fair way to think of it. And again, like if we're playing a near-term catalyst, then we don't want to go that far out in time. Unless we're going to put on a position that's a little bit larger, which then debunks the idea of like this catalyst. Unless there's some sort of strong backing for it. To that, I would play something a little nearer term in time if I wanted to play like the actual catalyst. But if I'm trying to play the longer term idea, QQ says get a Poke Bowl. Poke sounds kind of good. Oh, ZX Borg, you're on it. A beef dip? That sounds sick. I think that's the move. Yeah, I think that's the move. For defense instinct. So if we trade, let's say, did you say leaps? You did say leaps. So we go out here. Let's figure out what the vol is. The vol is 43%. Vol here is 43. What's the front vol? 52. So my guess is that's probably, let's see. That is what I was guessing, high. Because when you see the long-term vol matching the near-term vol, especially if the near-term vol is at the high end of the spectrum, so in this case, 94%, it tells us instinctually that it's probably pretty high. So the Leap vol right now is expensive.
That doesn't mean that it's not necessarily worth putting a position on if you feel, you know, that there's something strong there, but it does mean that you're definitely paying for it. You're coming out of pocket pretty big time. So yeah, the thing for something like UNH to trade it directionally, I really would try to play it based on the price movement, right? And if you can find some sort of near-term momentum or support, that leads to a better position, I think, than just trying to get in now as it's going down, because you're also paying a lot for vol. At least that's broadly what I see here. Reese says, when we look at term vol, is that the average of the whole chain's IV? Yeah, it's not all of it. Typically, it's a certain band of strikes, but yeah, effectively. All right, gang. That wraps me up. I'm out of here. Be an outlier. See you guys later.